Canadians generally suffer from home country bias. Now, if you don't want to be one of those people and you do want to start buying international stocks, where should you start? Virginia Au is the head of global equity at Leitwiler Investment Counsel. She heads up the team that manages a concentrated global equity strategy for private clients. And she's here today to share her 3 international stock ideas. Virginia, thank you so much for being here today.
Thank you. It's great to be here.
Now, your first pick is Global Payments. Tell us a little bit about that company.
Yes. Global Payment is based in the U.S. It is a payment processor company. It helps merchant process any type of payment that a customer would want to use, such as credit card, debit card, Apple Pay, or any digital wallets. And recently, the stock's been hit because of 2 main concerns in the market. One is the market worries that there's so many innovation and new types of payment, such as buy now, pay later, that will impact Global Payments' market position. And then the second worry is that because of e-commerce growth have been so strong that you see a lot of the new digitally native payment processor like Stripe, Adyen, PayPal, or Square eating into Global Payments market share. And I think this is very far from the truth. It is actually probably a misunderstanding of Global Payments' business model. I think on the first point, Global Payment is a payment processor. So they're kind of agnostic to how you would want to pay the merchant. In fact, the more types of payment makes it more complicated and makes their position more important for the merchant. And it makes it difficult for new players to come in because the complexity in technology has just increased. So more payment is actually great for them. Second point on e-commerce, there is some truth to it. E-commerce has been very strong, especially through the pandemic. But the thing is, there's a lot of merchants that have both online and physical presence. And they need someone who can offer a global, full service, high volume payment system that are not only good for online, but also have on-the-ground services. And frankly, a lot of these online or digitally native payment systems just don't have that on-the-ground presence. So that is a direct advantage for Global Payment compared to the newer entrants. And then so in our view, that Global Payment is attractive because you're looking at a 15% compounder trading at about 13 times free cash flow. And it is times like this where a bottom-up investor who, do extensive research can take advantage of these market mispricing.
Now, the second one that you like is Hays, a recruitment company. Is it because of the Great Resignation? Is that why you like this company?
Partly, and there's also a lot of structural trend going on in that area. Like you said, Hays is probably a name that not a lot of people have heard of, but they are the largest professional temporary labor company in Europe. They're actually number 1 in Germany in providing temporary labor. And that's really important, especially in IT area that is going through a digital transformation. Because in IT, they tend to be very project driven. So the temporary labor is actually more attractive than full-time labor. And so for Hays in Germany, 2/3 of their revenue comes from IT and engineering, which is an area of secular growth. And other secular growth for them is actually Germany is looking to employ more temporary labor. So regulation is loosening in that area. And again, we see Germany as a very good structural growth in the long term. And like you said, the war for talent and the Great Resignation, the tough, basically wage increase is just icing on the cake in the longer term for them. So I think there's a lot of good things going on, and the company is, from a valuation perspective, the company is trading at about 6% free cash flow yield when you look at more recovery in the works. And so I think that's definitely very attractive. And I think for us, we are long-term investors. So it's great to be able to focus on some of these longer-term trends and not to be just dependent on the shorter term, harder to predict macro ebbs and flow.
Now, the last one that you like is perhaps the best known, AstraZeneca. One of the criticisms, in a manner of speaking, that you may have heard is that a lot of the growth in these names has already been priced in. Is that the case with AstraZeneca? Why do you like this stock?
Yeah, it is definitely. AstraZeneca is not a cheap name. It's trading at 18 times, but we think there's a great profile of, growth and EPS and revenue growth, and also the risk profile is relatively lower than the other companies in that sector. So AstraZeneca is a global pharmaceutical company based in the UK. They have a terrific oncology portfolio, even though they're most probably right now more known for their COVID vaccine. And they also have very high exposure in emerging markets because of their treatment that they offer. And so there's a couple of different ways they're growing in the next 5+ years. So first, they're growing in just expanding label, just expanding usage case on some of their existing already approved drugs. And they're also growing in higher penetration in the geographic footprint in the countries they're already in. And this is actually a great way to grow because it really lower the risk of, research development. You're just expanding drugs that already have a good safety profile. So it's attractive in pharmaceutical companies. Another reason we like them is that their patent expiration is very low. They don't have any major drugs that will go off patent in the next 5+ years. And that is attractive because, when a drug go off patent, prices can go down more than 60%, which is very meaningful. And a lot of pharmaceutical companies in the sector are experiencing that issue, having the drug expire in the next 5 years. And I think that's why it's reflected in actually the lower multiple. For AstraZeneca, they don't have that risk, so you expect to pay slightly higher price for the company. And lastly, I mentioned about exposure in emerging market to encourage faster growth. Their proportion of sales in China is 3 to 4 times that of the average pharmaceutical companies. So they are going to see higher growth in the next 5+ years, and that is very attractive. So when you take all that into consideration, even though they trade at 18 times PE, which is not the cheapest in the industry, when you think about the number one, the highest growth they offer in the industry, when you think about the patent, the actual drug profile they offer, oncology is a more very defensible, no alternative treatment type of drugs. So that, again, lower that risk in terms of competition. That makes the whole company very attractive. And so for us, this is a very good example of, we don't look for just the cheapest company in any sector or in the market. We really do our deep research to look under the hood to see what we're buying, to see the quality of the company, because we don't want to end up buying a lemon.
Yeah, absolutely. Thank you so much for joining us today, Virginia.
Thank you.
For Morningstar, I'm Ruth Saldana.